Okay, so you want to own a yacht. You've seen them. Gleaming white hulls cutting through turquoise water somewhere between Saint-Tropez and Positano. A captain at the helm. Guests stretched across the sun deck with cocktails. Maybe you've seen it in a photo, or on a show, or at a marina where you walked past one and thought, what would it cost to own that thing? Here's the picture most people have. You buy the boat, you cruise when you feel like it, maybe you rent it out a few weeks a year to help cover expenses, and the whole thing more or less pays for itself, while you build memories and a killer Instagram presence. That picture is not wrong. It's just missing about 70% of the information. Here's the truth. A yacht is one of the most seductive, expensive, and structurally punishing assets a person can own. The purchase price, which is already staggering, is not the hard part. The hard part is what happens every single month after the wire clears. The hard part is what happens when the charter market softens, when the engine needs a rebuild, when the wrong season hits and the boat sits still while the bills keep moving. This is a video about how a yacht actually works as an economic object, not as a toy, not as a dream, as something that costs real money, requires real decisions, and has destroyed the finances of people far wealthier than most of us will ever be. Let's start at the beginning. Before we talk about numbers, we need to talk about what a yacht actually is, not what it looks like. Because most people think a yacht is a vehicle, something like a car, but on water. You buy it, you maintain it, you use it, you eventually sell it. That's the mental model. That's completely wrong. A yacht is a floating hotel. With a full-time staff, commercial-grade mechanical systems, regulatory compliance requirements that rival a small airline, and the carrying costs of a mid-size real estate asset. Except unlike real estate, it depreciates. Every year. Sometimes fast. When you buy a yacht, you're not buying transportation. You're buying a managed hospitality asset that you happen to be the primary guest of. That reframe matters enormously, because it changes every financial decision that follows. The captain isn't your driver, he's your general manager. The crew aren't decorations, they're your labor force. The marina slip isn't a parking spot, it's your commercial lease. Once you understand that, the economics start to make sense. Brutal sense, but sense. So, what does entry actually cost? The yacht market runs from mid-size to enormous, and the price tiers reflect that range pretty cleanly. A vessel under 50 feet, what most people would consider a serious luxury sailboat or a smaller motor yacht, runs somewhere between $500,000 and $2.5 million in today's market, depending on age, condition, and builder. Step up to the 50 to 70 foot range, which is where you start getting into real entertaining capability, a full crew cabin, and the kind of vessel you'd actually consider chartering out to guests, and you're looking at $2 million to $6 million. Go bigger, into the 70 to 100 foot category, and the range opens up to $6 million on the low end, $20 million or more on the high end. And the superyacht category, anything over 100 feet, starts at $10 million and climbs, theoretically, without ceiling. The largest privately owned yachts in the world have sold for $500 million. For this video, we're going to focus on the range that most serious buyers actually live in. A 60 to 80 foot motor yacht priced at around $3 million. Big enough to charter commercially, small enough to be in the conversation for someone who isn't a Fortune 500 CEO. And the numbers at this level are already extraordinary. One more thing about that $3 million price tag. In most US states, you're paying sales tax on it. And sales tax rules on boats are wild. California charges a flat rate of up to 10.25%. On $3 million, that's roughly $300,000 in taxes alone at closing. Florida caps yacht sales tax at $18,000, which is why so many yachts register in Florida. Rhode Island charges $0. Understanding this geography is not a side note. It can be the difference between owing $300,000 to a state government and owing $18,000. That's before the survey, the broker commission, the initial refit, and the cost of actually sailing the thing to wherever you plan to keep it. Industry brokers estimate that closing costs, transport, and initial preparation typically add 10 to 15% onto the purchase price before you've made a single cup of coffee aboard. On a $3 million yacht, that's another $300,000 to $450,000 gone before your first sunset sail. Now the part nobody talks about enough. What it costs before you make your first dollar. If you intend to charter your yacht, meaning rent it to paying guests, you cannot simply put it on a booking website and wait. You need a commercial license. In the United States, that means Coast Guard certification under Subchapter T or Subchapter K depending on passenger capacity. In international waters, many operators comply with the MCA, the Maritime and Coast Guard Agency out of the UK, which sets safety, equipment, and manning standards for commercially operated yachts worldwide. Getting your vessel certified commercially involves a structural survey, safety equipment upgrades, fire suppression system compliance, life raft certification, EPIRB registration, and in many cases, a formal inspection from a classification society. The costs here range widely, but industry estimates put the typical commercial compliance refit for a 60 to 80-foot yacht at somewhere between $50,000 and $150,000, depending on how the previous owner maintained it and how recently it was last certified. Your captain needs a commercial license. In the US, that's a Coast Guard-issued Master Mariner credential, minimum 600 tons for most charter vessels. The licensing process takes time and money, and experienced commercial captains know it, which is why they command premium salaries. And before any of this, you need marine insurance. A comprehensive policy on a $3 million yacht runs roughly 1 to 2% of the vessel's insured value annually. Call it $45,000 to $60,000 per year, just to keep the asset protected. That clock starts the day you close, not the day you start earning. So before a single paying guest walks aboard, you could reasonably spend $3.5 to $4 million all in on a vessel that was listed at $3 million. And you're already paying insurance and crew salaries with zero revenue to offset them. Sounds like a lot. It is. But it's not the hard part. Here's the part where people convince themselves the math works: the charter revenue. A 60 to 80-foot motor yacht in a competitive charter market, think the Caribbean in winter, the Mediterranean in summer, can generate real income. Let's break down where that money actually comes from, because it arrives in layers, not one lump sum. The first and largest layer is the base charter fee. A well-maintained, professionally operated 70-foot motor yacht in a prime location commands somewhere between $15,000 and $30,000 per week, depending on season, reputation, and amenities. Let's use $20,000 per week as our working number. Industry data from charter brokers suggests that a well-positioned charter yacht in this size range typically books 8 to 12 weeks per year. At 10 weeks and $20,000 per week, your gross charter income before anything is deducted, $200,000 per year. The second layer is the APA, the Advanced Provisioning Allowance. When clients charter a crewed yacht, they prepay roughly 30% of the charter fee to cover fuel, food, port fees, and activity costs during the trip. On a $20,000 week, that's $6,000 going into an operational kitty. This doesn't flow to the owner as profit, but it covers operating costs during the charter that would otherwise come out of your pocket. Think of it as a cost offset, not income. It's real money that makes the charter more viable, even though it disappears into fuel tanks and provisioning invoices. The third layer is charter management fees, except this one runs in reverse. It's money leaving, not arriving. Charter management companies, which handle marketing, booking, guest coordination, and vessel scheduling, typically take 15 to 25% of gross charter revenue off the top. On $200,000 in gross revenue, that's $30,000 to $50,000 gone immediately. You're now working with $150,000 to $170,000 in net charter revenue. The fourth layer is ancillary revenue: onboard extras, extended bookings, corporate events. Some owners negotiate directly with repeat clients and earn a small premium outside the management structure. In a good year, this adds $10,000 to $20,000 on top. Not transformative, but real. So total net revenue picture in a good year, approximately $160,000 to $190,000. Keep that number in your head. We'll need it in a moment. Here's where the floating hotel metaphor earns its keep, because every single month, whether the yacht is at sea, in a marina, or sitting idle at a dock in February with no bookings for 6 weeks, the bills arrive. Crew is your largest fixed expense, and it will surprise you with its immovability. A 70-foot charter yacht typically requires at minimum a licensed captain and one additional crew member, usually a mate who handles everything from line handling to guest service. A captain on a commercially operated U.S. charter vessel earns between $80,000 and $150,000 annually. An experienced mate runs $40,000 to $80,000. Add health insurance, travel costs for crew changeovers, and the legally required crew certification and training costs. And your annual crew budget is somewhere between $150,000 and $250,000. That number does not go down in the off-season. Crew contracts are annual. Your boat needs someone on it regardless of whether guests are. Marina fees are your second major fixed line. In premium markets, think Fort Lauderdale, Palma de Mallorca, Antibes. Slip fees for a 70-foot vessel run $2,000 to $5,000 per month. That's $24,000 to $60,000 per year just for a place to park the asset. In Monaco or Saint-Tropez during high season, slip fees for large yachts can hit six figures annually. We'll use $30,000 per year for a mid-range marina. Fuel is dramatic and variable. A twin-engine motor yacht burning diesel at cruising speed can consume 20 to 50 gallons per hour. For a charter week with 6 hours per day of operating time, you're looking at several $1,000s in fuel per trip. Annual fuel costs for a moderately active charter yacht, $20,000 to $40,000, depending on how far and how often. Maintenance, and here is where the 10% rule earns its reputation, runs 10% of the vessel's value annually as an industry baseline. On a $3 million yacht, that's $300,000 per year in maintenance. In practice, newer, well-maintained vessels might come in closer to 8% in a good year. Older vessels, boats with complex systems, vessels in saltwater environments, they can push well past 12 or 15%. Call it $250,000 for a well-run operation. Insurance, $60,000 per year as we established. Regulatory compliance, inspections, certifications renewal, and miscellaneous administrative costs, another $15,000 to $20,000 per year. Total annual operating cost for our 70-foot charter yacht, approximately $525,000 to $580,000. Set that next to the revenue, $160,000 to $190,000 in a good year. The gap is not a rounding error. The gap is the point. Here's the structural risk at the heart of yacht ownership that very few people outside the industry ever fully reckon with. It's called the fixed cost trap, and on a yacht, it's more aggressive than almost any other asset class. In most businesses, costs are somewhat elastic. You sell fewer products, you buy less inventory. You have fewer customers, you schedule fewer staff hours. Revenue and cost have at least some relationship to each other. On a yacht, they don't. Your captain gets paid whether you have bookings or not. Your marina slip charges you in July the same way it charges you in January. Your insurance premium is calculated annually upfront. Your maintenance schedule is driven by engine hours and calendar cycles, not charter revenue. What this means is that the entire financial fate of a charter yacht hinges on one variable above all others: utilization. How many weeks per year is the boat earning money? At 10 weeks of charter per year, which is a reasonable baseline for a well-managed vessel in a good location, you're generating roughly $160,000 in net revenue against $550,000 in costs. Your annual cash deficit is approximately $390,000. Every year, even in a good year. At 15 weeks of charter, an excellent year, achievable only in premium locations with strong marketing, net revenue climbs to around $240,000. Deficit narrows to roughly $310,000. Still a significant annual loss, just a smaller one. Only at around 25 to 30 charter weeks per year. Essentially the maximum realistic utilization for a single crewed vessel that also allows for owner use and maintenance periods. Does revenue begin to approach operating costs? And even then, you're not accounting for depreciation, which on a production yacht runs 7 to 10% of value per year. On a $3 million vessel, that's $200,000 to $300,000 in paper losses annually as the asset declines in resale value. This is the structural reality that most prospective yacht owners either don't know, don't believe, or quietly decide to ignore. The economics of a private charter yacht are designed to lose money, and the only question is how much. Let's look at one specific case study that makes this concrete. The Ritz-Carlton yacht collection was not founded by a dreamer who didn't understand finance. It was backed by Oaktree Capital Management, one of the world's most sophisticated distressed debt investment firms, along with the government of Singapore Investment Corporation, one of the largest sovereign wealth funds on Earth. These are not naive investors. They understood numbers. The venture was announced in 2017, designed to operate ultra-luxury cruise yachts under the Ritz-Carlton brand through a licensing agreement with Marriott International. The thesis was elegant. Take the loyalty base of one of the world's most recognized luxury hotel brands and convert those high-net-worth travelers into yacht cruise guests willing to pay premium prices for an intimate, super yacht-style experience. The first vessel was contracted with a Spanish shipyard, Hijos de Barreras, which had never built a cruise ship before. The yard ran into severe financial difficulties during construction and ultimately collapsed. This delayed the debut of the first ship, named Evrima, by more than 3 years, pushing the launch to October 2022. Meanwhile, more than $1.5 billion in debt had been drawn down from lenders including Crédit Agricole and Spain's CaixaBank to finance construction of 3 vessels and service existing obligations. Once operational, the Ritz-Carlton Yacht Collection faced the same structural challenge at massive scale. The product was extraordinary. Guests who sailed reported genuinely exceptional experiences, but filling the cabins at the prices required to cover costs proved brutal. As of early 2026, occupancy sat at just 51%, against a target of 80 to 85%. In the first quarter of 2026, the company reported a negative adjusted EBITDA of $19 million, actually an improvement from the $33 million loss in the same period a year earlier. The total accumulated losses from 2017 to mid-2026, nearly $700 million. Total capital injected by shareholders, over $1 billion. Marketing spend in 2025 alone, $104 million. And still, the cabins weren't full. Crédit Agricole, with $918 million outstanding, agreed to defer $171 million in repayments in mid-2026 to prevent a default. Shareholders injected another $275 million in fresh equity to stabilize the balance sheet, the company's new profitability target, 2027. Analysts cited in the Financial Times suggest even that may be optimistic, and the real inflection point might not arrive until 2029. Here is what this story tells you. If Oaktree Capital, Singapore's sovereign wealth fund, and the Ritz-Carlton brand could not crack the economics of luxury yacht operation at scale, despite $100 million a year in marketing budget, the structural difficulty of making money with yachts is not a problem you solve by trying harder or spending smarter. It is built into the asset class itself. Good year, bad year. Let's put the numbers on the table. Our vessel, a 70-foot motor yacht purchased for $3 million, based in a strong charter market, professionally managed. In the good year, the season cooperates, 12 weeks of bookings. Strong demand in peak season allows a rate of $22,000 per week. Gross charter revenue, $264,000. After management fees of 20%, net charter income lands at $211,000. Add $15,000 in ancillary revenue. Total income, $226,000. Operating costs, $540,000. Crew at $200,000. Marina at $30,000. Maintenance at $250,000, fuel at $35,000, insurance at $60,000, compliance at $15,000, annual cash deficit $314,000, not counting depreciation. In the bad year, weather events disrupt the Caribbean season. A mechanical issue takes the boat offline for 6 weeks. 2 charter bookings cancel. 7 weeks of actual revenue at $18,000 per week. Gross charter revenue, $126,000. After management fees, $101,000. No meaningful ancillary income. Total income, $101,000. Operating costs don't change. Still, $540,000. Annual cash deficit, $439,000. The difference between a good year and a bad year on this vessel, $125,000. Not in profit, in loss. Just less of a loss, or more of one. The gap between those 2 years is $125,000, and neither year produced a positive return. So why do smart people with real money keep buying yachts? Because the economic analysis above, while accurate, misses something that wealthy buyers understand, and that most financial analysis refuses to quantify. A yacht is not purely a financial asset, and the people buying them know it. The first reason is tax strategy. In the United States, if a yacht qualifies for commercial charter status under IRS rules, meaning it operates commercially for a minimum number of days per year and satisfies certain passive activity standards, the owner can deduct operating losses against other income. On a vessel burning through $300,000 to $400,000 in annual losses, the tax shield can be significant for a high-income earner in the top federal bracket. This doesn't eliminate the losses, it just makes the government share the cost. The second reason is appreciation in specific categories. While production yachts depreciate predictably, certain vessels, custom-built boats from elite European yards like Feedship or Lursen, sailing superyachts with strong charter histories, vessels tied to famous designers or remarkable provenance, can hold or even increase in value in a way that standard production yachts don't. This is the yacht equivalent of buying a Modigliani rather than an index fund. The asset is real, the market for it is thin, but for the right buyer, the math of depreciation doesn't apply in the same way. The third reason is status and access. A superyacht is one of the few assets on Earth that functions simultaneously as a residence, a social infrastructure, a vehicle, and a statement. The kind of deal flow, relationship access, and brand signaling that comes with yacht ownership at the top tier doesn't appear on any balance sheet. But for the private equity investor, the real estate developer, or the tech founder in the right circles, the yacht pays dividends in the currency that matters most in those worlds: access. And the fourth reason is the simplest one. Some people just like boats. Not everything has to pencil out, but here's what this entire journey through the numbers should leave you with. We started with the simple fantasy: buy a yacht, enjoy the ocean, let charter income cover your costs, and quietly build an asset that reflects your success. Now you know the actual shape of the thing. You know that the purchase price is the beginning, not the headline number. You know that operating costs run in a range where revenue can't realistically catch them without extraordinary utilization. You know that the smartest investors in the world, with the deepest pockets and the most recognizable brand in luxury hospitality, spent nearly a decade and $700 million trying to solve the same math problem, and still aren't there. And yet, there's something worth sitting with at the end of all this, something the numbers alone don't capture. Yachts have been among the most persistent symbols of human aspiration for 3,000 years. Since the ancient Egyptians built gilded river barges for their pharaohs, since the Dutch East India Company gifted yacht-style vessels to English kings as diplomatic tools, since American robber barons made the racing yacht the defining accessory of the Gilded Age. No asset this financially irrational survives that long purely by accident. What a yacht actually sells is not transportation, not even luxury, and certainly not return on investment. It sells the oldest human fantasy there is: freedom from the land. The idea that you could, if you chose, cast off the lines right now, point the bow toward the horizon, and go anywhere the water goes. That's not an investment thesis. That's a feeling. And feelings, it turns out, are the most expensive things people buy.